Hi everyone, welcome to Karan's Gyan. In, in the past few videos, I talked about forward markets and the structure of future contracts. To those who watched these excruciatingly long videos, I congratulate you for making this far. And you have finally arrived at what you wanted to learn, the trading of futures. So, before I begin, to those people who haven't watched the previous videos, please watch them because it'll help you immensely in understanding this. Starting with the futures trading. So, you guys need to understand people who trade in futures, they have a very directional view. They buy futures when they think certain thing is gonna go up, and they sell futures when they think certain thing is gonna go down. They have a very positional view. They are based on direction. All right, what direction the stock or what direction the commodity would be taking. All right, and based on it, they'll be making their bets. All right. So I would take an example of a certain financial event. So why am I taking an example of a financial event? Because financial events drive prices of shares, commodities, asset classes, anything and everything. It is a financial event that is responsible for the change in an asset's price. Right. So I'll give you an example of TCS. So on TCS, so on 15 December, TCS had a board meeting, and after board meeting, they told their shareholders that they expect not much revenue growth for the December quarter, and so what happens is each company has a board meeting once every quarter, and after this board meeting they disclose their results or they disclose their view on the results. All right, so possibly it is after that board meeting TCS is discussing their view on the result, and they're saying they're cautious about growth and revenue. And markets, they generally don't like such strong statements by a company, because a company should be confident in its revenue growth. If a company says we're not confident if our sales would increase or if our sales would even be as what they are, it rings a lot of bells for shareholders and they go crazy. They start betting against these stocks. So exactly, Tata Consultancy made a very strong statement, because of which their stocks got hammered. All right, as you can see, a, a heavyweight stock like TCS falling 4% today. That's a lot of money, because TCS has crores and crores, lakhs of crores of people's money, and 4% of lakhs of crores is too much. Generally, these heavyweight stocks fall an average of a percent or two on bad days. So this must have been a terrible day. All right. So I look at this news and I say, well, December is a quarter for IT companies, which is always bad, historically speaking, because what happens with IT companies is generally they have their business abroad, they have their business in US and Europe, and you all know what happens, what festival is there on in December, Christmas. And who hasn't heard about Christmas holidays or Christmas breaks? So most of the corporates abroad are, they're shut down because it's Christmas, and who wants to work on Christmas? As a result, there isn't as many sales as TCS has. This is a common known fact, and it's generally factored in share prices. Okay, so what happens is, I think this is an adverse price reaction. I feel it is already known that December is a quarter where IT companies show a decline in their revenue. So why is the share falling by 4%? I don't agree with this price. I want to challenge this price. So what do? I challenge this price by buying this share. So instead of buying share, I'll buy futures. Why do I choose futures over shares? Well, I'll tell you about it in the later videos, because it is related to leveraging. and leveraging is an important thing to consider when trading in futures. But today, since I'm just talking about futures and how they're trading and what is the psyche behind trading of futures, I'll stick to what I'm telling you fundamentally right now. All right. So I what do I do? I see this is as you see there is series equity written. So this is a share. All right. So future actually tracks the underlying. So if the share goes down, you see series equity. So if the share goes down, the future would also go down. All right. So I'll check up the price of TCS. So what do I do? This snapshot is exactly is from the NSE website. You can go and check it out at NSE. I go to NSE website. I type TCS. I TCS equity series. I get this snapshot. And if I want to get a derivative quote, I'll click at this red box and I'll get a derivative quote. All right, I click at this red box and I'll get something like this. So what do you see in this? You see the price of future. Price of future is this. Even future is down. Instrument type stock futures. Symbol TCS. Expiry date 24 December. Alright, I told you every derivative contract has an expiry. Expiry date is the date when that contract has to be obligated. So what does this mean? It means that if I buy futures all right, if I buy Tata Consultancy future, I'll have at 2,374 rupees 90 paisa. I'll have to buy stock of Tata Consultancy Services on the expiry date at this price. It means I'll buy TCS on the expiry date of 24 December 2014 at the price in this blue box. All right. Um, I told you the market lot. Market lot is the lot size, which is 125. Underlying value. Underlying value is the spot price. Spot price is the price written here. You know, like spot price. There's a time difference. There's a price difference here, is because it takes time for me to take a screenshot and price changes like really quick. So actually, this 362 has become 359 because it took me some 2 minutes to take a screenshot. All right. So this is an underlying value. Underlying value is Tata Consultancy spot price, and this is future price. Spot price is the price going on at the spot. It is this price going on right now. Okay, today's date, as I told you, is 15th December. So the spot price right now is this 2,359 rupees 95 paisa, and the future price is 2,374.90 paisa. There's a difference between spot price and future price. I'll get to it later. But what it means is the future price is trading at a premium to the spot price. There's a reason behind it. I'll come to it in the later videos. But for now, I'm strictly talking about futures trading. All right. So as I told you, like recall, I told you the futures price trades. The future price tracks or mimics the spot price. That means if the spot price is down, the future price is also down. So you would ask me, the TCS spot price is down 3.61%, but why is the future down by 3.77%? What is the difference? And like I asked you before, why is the spot price different from the futures price? What is the reason behind it? Well, these are valid questions, and as I told you, I'll be talking about futures pricing formula. There's a pricing formula behind the future value and the spot value. There's a formula in which these two variables are there, and there's a third variable, which I'll talk to you when I talk to you about. All right, so keep it out of your mind. I'll come to it later. But just for you to understand, the price of futures have moved in line with the price of spot price. almost the same. Like the spot price has fallen by 3.61% and the future price has fallen by 3.77%. Both are down and both are approximately equally down. All right. I explained you this is the stock future symbol TCS, expiry date. This is the future price, underlying value, market lot, order book, buy quantity, sell quantity, etc, etc. All right, now we'll go behind this. Now I said I want to buy TCS because I feel such a loss is unwarranted, such a loss shouldn't be there. So what do? I open my trading terminal and I call my broker and I say, hey, TCS price is going on as 2374 rupees 90 paisa and I want you to buy me a lot. All right, so my broker would be all right, he'll check for these four things. The four things would happen, he'd say, all right, he'll see if I have the required margin. If he like I told you, there needs to be some token amount which the exchange calculates every day, based on standard deviation and variation of how volatile the stock price is. Based on it will calculate some margin validation and margin, and that token amount I have to give when I either buy a future or I sell a future, either way. So in this case I'm buying a future contract. So since I'm buying a future contract, there needs to be a second person who needs to be sell a future contract, because I can't buy apples if there are no apple seller, and there needs to be someone who's selling apples for me to buy apples. So there needs to be a counterparty. Now do you see something? I think TCS is gonna go up. That's why I'm buying TCS. Whereas the counterparty, the seller, he thinks that TCS is gonna go down further. He thinks that yes, this TCS is gonna perform bad and it needs to be hammered down more. So it says, yeah, I'm gonna sell TCS. So that there are two sides of the coin. The coin is the same, but there are two sides to it. The seller thinks the price is gonna go down, and I think the price is gonna go up. Both of us can be right, both of us can be wrong. You know. Next, sign off. Like I told you, future contract is an obligation. This is not a forward contract where I can cheat the other person. There's an agreement, so obviously I need to sign. There's a sign column in a contract which you physically sign, but this is taking place electronically. So there's something called digital signature. So there'll be a digital signature, and the token amount which I paid as margin would be blocked, and it'll be with the broker. It'll be whoever has bought the futures for me, because I'll be buying futures through someone, through a broker, through someone who is part of the exchange, through someone I'll buy, and he'll block the margin for me. I can't use this amount money. So for example, for me buying one lot of TCS, margin amount is 1 lakh rupees. I need to have 1 lakh rupees margin in my trading account, and that 1 lakh rupee margin be blocked. I can't use that 1 lakh rupee until I end my contract. That means until the contract either expires or I sell my open position, because I bought the future contract. Right now, if I sell it, the open position is closed, because the sell cancels the buy. All right. So now I have completed the first steps, and I own one lot of TCS future contract. Okay. Now what do I mean by I own one lot of TCS future contract? So this means since I purchased TCS future on 15th December 2014, I have digitally entered into an agreement with a certain counterparty, agreeing to buy 125 TCS shares at 2374.9. Okay, this is what it means. This means that I'll be buying 125 TCS shares at rupees 2374 rupees 90 paisa when the contract expires on 24th December 2014. This is the gist of it. This is a contract. Because I bought the future value, future contract at 2374.90 paisa. Expiry date is 24th December. So when 24th December comes, irrespective of what the price of TCS is then, I'll have to buy TCS at this price. Alright, just similar to a forward contract, like I explained you in the gold video where ABC Jewelers is buying gold from XYZ gold dealers. Alright, enough of that example. I'm tired of it, but yeah, this is what it means. So, comes 24th December, there'll be three scenarios again. Okay, the three scenarios is that I made a mistake here. It is spot. So spot price would go up, spot price would go down, and spot price remains unchanged. So spot price is the current price of the future. So what happens with future is, since I'll be buying shares from the counterparty at rupees 2374.9 rupees at 24 December, this would be compared to the spot price then. If the spot price on 24 December is more than 2374, then it would make scenario 1 the spot price. So for example, TCS stock price goes up on 24 December. It goes from this price to 2450 rupees per share. Okay, that means if the spot price has increased, obviously the future value has also increased. Okay, so as a result, I'll earn a profit which is the difference of both of these, as seen here. So I'll earn a profit of 75 rupees 10 paisa. Yeah, and since the lot is 125 shares, I'll earn a total profit of 9,387 rupees and 50 paisa. Similarly, if I'm earning this much profit, obviously my counterparty or the seller would incur a loss. Okay, because he's selling, because I'm buying the share I'm buying the share which is worth rupees 2450 rupees at 2374 rupees. So the difference is in my pocket. This is what it means. I'm the buyer of a future. That means when the expiry date comes, I'll buy these many amount of shares from the seller. you know so this is what it means, simplified. This is the case now. TCS stock price goes down. All right, TCS price has gone down. TCS price has gone at 2374 rupees from 2300 rupees per share. I mean, sorry, the TCS price has gone to 2300 rupees, and I bought the futures at 2374 rupees. Alright, so now 24 December has come, its expiry day. I have to buy the share which is worth, the TCS share which is worth 2300 rupees. I have to buy it for 2374 rupees. Do you see it? Are you understanding what I'm trying to tell you? So what happens is, a future, a person who buys future, he's buying if I'm buying futures, one lot futures of TCS, I am buying TCS 30 days from now, or not 30 days, in this case from 15 December to 24 December. you know 9 days from now, I'll buy this stock from the future seller. I'll buy this stock at 2374 rupees 90 paisa when the future contract expires, irrespective of what the price of the the stock is then. So in the first case the price went up, So I'm buying expensive share at a cheaper price, at the future price me and the seller agreed to. Okay, when the price has gone down, I am buying a undervalued share, a share which is valued at 2300 rupees, at 2374 rupees and 90 paisa. I'm paying 74.9 rupees or almost 75 rupees more per share. As a result, I'll have a loss of 9375 because 75 into 125. Alright, I'll have a loss this much. But if similarly, if I'm having that loss, the seller is having a profit of this much, 9375, because my loss is his gain and his loss is my gain. I'll explain this concept again. This is kind of hard to grasp, I understand, but future the future buyer would buy the stock at a particular price which is agreed upon when the contract expires. The future seller sells the stock at a particular price which is agreed when the contract expires. So future buyer would buy the stock when the contract expires. The future seller would sell the stock when the contract expires, irrespective of what the price they agreed upon and what the price is actually then is actually when the contract has expired. All right, just remember there are two things: future price, spot price. Keep it in mind. Okay, now the price has remained unchanged. The stock price has remained unchanged. As a result, no one has benefited. Neither I have benefited nor the seller has benefited. We both are fools in getting into a contract which has just remained constant. We have wasted our time and our money. All right, not our money because the price has remained unchanged, but maybe our brokerage. Okay, so what happens is I don't want to wait till the contract to expire. I say, see, if the price movement is there within the next 3 4 days, I'll cancel my open position. I'll square off. What I mean by square off is if I have bought a futures contract, I'll sell that same contract. Okay, if I've sold the futures contract, I'll buy the same contract. So this is what I mean by squaring off. So exploiting trade opportunity. So what happens is comes 16 December. Okay, the price has gone up to 2460 rupees. Alright, what do? I want to cancel my trade. Like I told you, a forwards contract cannot be cancelled. Alright, you have to stick till the contract expires. But I can sell my same contract to someone else. I can transfer my contract. This is the main benefit of futures contract. It is not rigid. I can transfer my contract to someone else who's willing to buy it. So I sell the contract which I have already bought at 2460 rupees. I make a whooping profit of about whatever. Okay, so I made money overnight and I've sold at 2460 rupees. Alright, so if I have a futures contract with me, it's called an open position. If I want to if I want to close my position, I need to square it off. Alright, so if I have bought a future contract, I want to square it off, I'll sell it because I no longer expect the price to go higher because the price has already gone higher. Or I think, alright, the price has fallen too much and there has been some bad news, and I think it's better to get out of this position than waiting for expiry to come. So I sell my position. So squaring off by sell. So you can square off sell by buy. There's a seller of future who can square off it by buy. So the seller says, all right, the stock has taken a beating, it can't be hammered no more, or the results were better than what people expected. I don't think there's a point waiting for expiry to come. I'll get out of the existing position. So he cancels the sell by buy. So this is what it is of how futures are traded, how to trade futures, what are open positions, what does buying a future mean, what does selling a future mean, what is expiry, what is lot size. I've given you an example through screenshots, through price, through everything. In the coming videos I'll talk about the things I didn't explain in this. I didn't explain you about the leverage, as in why people have bought futures instead of shares. What is the point of buying futures? I'll talk about leverage, okay, and I'll talk about the price discrepancy, which I was talking about here, the futures pricing formula. I'll explain you what the futures pricing formula is. I'll get into more maths and I'll discuss about the next level of futures, which is options. So guys, stay tuned. If you guys like my video, press the like button. If you want this PDF, sure, give me a comment, holler at me, and I can give you this PDF. And if you guys want more videos, subscribe my channel. And if you guys have any doubt, or if you want to correct me, or if you want to ask me a question related to other derivatives or anything that I missed, please comment. Alright guys, thank you very much. Have a nice day.